All right, hello everybody watching from YouTube. Hello everybody watching from the Quant Data stream. This is your host, of course, Abe J. Today is going to be a very good session. So today I want to go over a day that some of us struggled with, but some of us really profited from. And going on, hindsight wise, it was a very obvious day, but we want to be traders that can capitalize on these moments as it happens. And today I'm going to show you how we can do that with quant data. So titled for this presentation, looking for clues in the markets. We're going to recap November 20th, SPX. So for those of you guys that traded on November 20th, the Thursday with us, it was a very interesting day. Massive sell-off in the markets, right? And so the first thing we want to go over is determining our bias and our reasons for it, right? That's something we do every trade we take, right? Just before we take it, we have to have a reason for it, right? How many of us just throw trades in just because? Throwing money into the markets with the hopes of making money. That's not how we do it here in quant data. That's definitely not how I do it in the markets. So a couple things we want to do before we establish the bias, right? Trend analysis, right? What's the current price? How is the current price trending, right? We know that the open of the market session, we were slowly grinding up. We know that there was a big gap overnight because of NVIDIA earnings. So trend analysis, how is the current price trending? Key levels, right? Open price, previous closing, any gaps. We did have a huge gap. What is the current MVCs, both upside and downside? And then, of course, our favorite for bias is net drift. Which side's winning? Calls or puts? And, of course, we filter it for specifically buys only. Right now, macro context, we knew that on Thursday there was nothing. No major economic calendar stuff that was happening. Sector considerations, we knew tech had a big boom, all semiconductors because of NVIDIA earnings doing very well. And then also, of course, the VIX. So what was happening on the VIX during that day as well? We know that as price moved up from the open, just slowly moving up, the VIX actually also moved up too. Now we know the VIX is not just a fear gauge, right? I know some of us like to call it a fear gauge, but it's actually not true. It's just a gauge of uncertainty, right? That can go for both ways, calls and puts. So in this picture, I want to show you. So on the left side here, we have SPX. Now this box is filtered, or it's boxed around the 20th, the day that we had that massive sell-off. And this one here on the right is the VIX. But what are some of the levels we talked about just now? Opening price, right? So this was the open price, right? This orange line right here. This was the closing price of a previous day. And then we have the blue box here. This blue box was the gap. Now, of course, back at our previous slide, open price, previous closing, any gaps, right? And then, of course, the MVCs. Now, we know MVCs are targets for price, but when we have a pivot like we had on this day, you can actually use them as strikes to sell as well. So I'm going to show you that in this presentation. But as you can see, price was slowly trying to climb up, and then eventually we just kind of gave it up. And the VIX steadily just continued climbing up on this day. So these are the kind of considerations that we need to remember. And then I want to show you guys, of course, the data before the sell-off. So I was bullish. If anyone remembers, I actually sold 6,700 strike as a put credit spread on this day, thinking that NVIDIA earnings would, hold the bias, right? We would just remain up there and not come down with any sort of significance, right? So what are we seeing here? Net drift, bit of a mess from what we can see here at this point, from the open all the way up until 750. Right now, I want to show you how accurate this data can be to tell you that, okay, we're in trouble. We are flipping biases. Delta was super strong. I want you guys to pay attention to right here, 6,700, 6,700 at 7:56 a.m. By the way, I am on the West Coast. So 7:56 a.m. We're right here. This is what that delta looks like. It's very strong. We know that 1 billion plus is usually considered strong. We don't usually see a billion plus flip. And if it does flip, we know that it's going to be a massive trigger for something to happen in the markets. Right? So we're going to continue moving on now. So this is the data before the sell-off. This is when things changed for us. And this is when we had to get rid of those put credit spreads and start piling in to call credit spreads to manage our trades, right? To hedge accordingly and, of course, come out the markets in the green. What did we see? So 7:56 a.m., we saw relatively things were pretty bullish. And then 8:01. So literally right at 8:01, what do we see? We saw that all of a sudden, this happened drastically, right? 6,700 just flips from positive 1.4 billion to negative 875 million. Does everyone see that difference right there? I'm going to bring it back two slides. Bam, there we go. All is smooth sailing. Things are looking pretty, right? We might move to 6,800 and then the pivot. Bam, right there. Right? So what does this tell us? This told us that the market all of a sudden decided to switch bias. A few things. 6,700 flipped. 6,700 on Gamma and Delta. Vanna was not really showing us the signs, but the other trigger that we saw was net drift. Look at this point right here. We have the net drift crossover. Not only does it cross, we see the divergence, right? We see calls are moving up and they are starting to sell off. Sorry, puts are moving up and they're starting to sell off their calls. You see that right here? So this was our point where, okay, all the things are lining up, right? These are the clues that we're looking for in the market to tell us that, okay, things are probably going to change. We're no longer bullish. We need to change our bias. We need to ask ourselves those three questions again, right? SRS, structure. Oh, sorry, scenario, risk, structure, right? What's the most likely scenario for price now as things have changed, right? Is it worth our risk as these things have changed, right? Now, how many points are we looking to the downside? Well, if we look at the gap and we look at 6,700 and we know that the market takes generally a lot of effort to flip a strike that's over 1 billion down to negativity. We know that this may be worth our risk. Depends on how you want to take the trade though, right? And then number 3, what's the trade structure that best fits this scenario? We'll move on. So identifying the pivot. So the reversal signal. 8:01 a.m. PST, the DEX profile shifted quickly, showing the market was suddenly short the 6,700. Remember, it was positive 1.4 billion. It is now short over 800 million. Generally takes a lot of effort for the market to do that. Which Greek takes precedent? Now, I know a lot of you guys, I can see so many of you already in the chat are all about the gamma, right? How many of you guys came into quant data just expecting some sort of gamma analysis, right? Give me that thumbs up. Don't be shy. Don't be shy. I already know some of you guys definitely came here just for gamma. But I can tell you that if you're just looking at one Greek and you're not understanding the rest of it, it's actually not going to help you too much, right? Because we know that delta actually takes precedent. In all pivot scenarios, delta usually reacts first. I'm going to say it again. In all pivot scenarios, delta reacts first. Okay, so we saw delta, again, 6,700. It was over. We already knew. Market is going to take a beating. So momentum wrapping. To confirm the pivot, we can use our other data sources to confirm the pivot, right? So to confirm the pivot, we can utilize a tool like net drift, filtered for buy orders only. Okay, what are the buy orders? Of course, it's this right there. I don't know why I'm putting my finger. I think you guys can see it like I'm some sort of teacher. But these net drift orders are filtered for buys only. So you can see that puts started buying and calls started selling right there, right? So this is our other confirmation that, okay, the momentum is ramping. The spread or the split off of the divergence is getting stronger. This is more than likely going to be a very drastic kind of a drop. Okay, and the support broken, right? New low of day would be a fantastic trigger. By that point, I know a new low of day wasn't broken just yet, and then eventually it really started to fall, right? And if we go back to the chart, you can definitely see that the market fell pretty fast. There was not a green candle in sight for some time. All right. So why puts gained rapid premium expansion? So we went over this in the last class, which again I will have to re-record for everyone. But we know that when the market goes up, I know I'm going to skip this a little bit, but when the market goes up, it's generally gamma and delta, right, increasing those premiums. But when the market goes down, it's gamma, Vanna, and delta increasing those premiums. So you get a 3-part expansion in premiums. So a sudden shift in sentiment introduced a wave of volatility, right? As the market comes down, of course, Vanna has increased. The column drift up was replaced by a massive sell-off of everything, leading to what we call a Vanna squeeze. So who here has heard about a gamma squeeze, right? I'm sure everyone knows about it. I'm sure, you guys who traded around the GME era, right? You guys know, oh, it's a gamma squeeze, right? Everyone's going to do this. But when the market comes down and flushes with some sort of significance, it's usually due to volatility expanding to something crazy. And we kind of call that a Vanna squeeze. You don't see it as often because the market is designed to forever go up. But when the market comes down, you should realize what's actually increasing those premiums on your options contracts. Now, there is something to remember as options traders. And I know that some of you guys don't know this, but based on math, based on the Greeks, based on how options are priced, puts always pay more than calls, right? That is why on November 20th, a little bit of regrets, but there are some put contracts, 6650 puts on SPX specifically. They went from $1.12 all the way to $108. You won't find that generally on calls. That kind of pricing generally doesn't happen. But for puts, it actually does happen, especially on a Vanna squeeze. Now remember this, when the market goes up, it's gamma plus delta. When the market comes down, it's gamma, Vanna, and delta. So 2 versus 3 things adding to the premiums, right? So give me a thumbs up in chat if you understand what it is we're going through right now. And then we're going to move on to the next bit. A little bit of extra observation as well. If you're looking and studying volatility, we also saw that volatility on 0 DTEs expanded from that 7:56 a.m. It went from 32% at that point all the way to 58%, which is where volatility peaked out on 0 DTEs. And that happened in just a matter of 25 minutes. So for those guys that, like myself, who still hold a lot of credit, around the 25-minute mark was where we started to participate in the markets again, because implied volatility no longer continued going. It kind of hit a floor. Sorry, it didn't hit a floor. It hit a ceiling, And so that told us that, okay, there should be no more. We've stopped. We should be able to put on some risk again into the markets. Now, I know some of you guys remember that I sold puts into the market at 6,500 strike. That was silly. It's pretty easy money there. But we'll continue going on with this. Perfect. So 3 thumbs up in chat. Like that. I like that a lot. So managing risk and selling the strikes with the most value. Now, I know a lot of you guys have come into the quant data community learning about the ABJ trifecta, right? Trying to pick the strikes that are the most valuable and having price move towards those strikes to, earn some sort of income from it. But not only can we use gamma and Vanna to buy those strikes, right? Not just buy side. You can actually use them to sell them as well. So risk management protocols when things change, right? When things change and when things pivoted for that 6,700. Usually my go-tos are these 3. So position sizing, reduce positions by 50% immediately, right? That means taking losses and confirmation of the trend break to minimize exposure, of course. We re-enter when volatility returns and slows down. And I should have wrote returns to a mean, but I didn't do that. That's okay, as long as you guys understand. I'll edit it before I send this slide out. But we re-enter when volatility starts to stop, right? It's no longer expanding. It tells us that a floor in volatility has been made, and we are going to start getting decay again, right? So stop loss adjustment. A lot of you guys ask me what I do normally when things pivot. Do I take losses right away? For anything that's 5 wide, I'm more than willing to adjust them. But anything 10 and over for SPX, I close them immediately because I'm wrong. And I don't want to suffer a day where I have to hold positions until the very end. Also, we know that from the halfway point of New York City lunch, generally it's very hard to sell credit anymore. So from that point on, especially if you're wrong at that point, there's almost no saving yourself, right? So for those guys that are selling credit, again, the halfway point of New York City lunch, so 9:30 a.m. PST, 12:30 p.m. EST, that's generally when you have to stop selling zero DTs and you just kind of manage your risk that you already have on accordingly, whether by taking losses or debiting. So after that halfway point, buying options is actually more valuable for you than selling them into the markets. Hedging. This is something that I know a lot of you guys have trouble with, especially with sell side. It's what do you do when you're wrong? Do you just kind of hold on to your existing positions and pray? No, you want to manage them accordingly. So hedging, what I normally do for my protocols is I start selling the most valuable strikes on the opposite side. So we saw that the market started flush. I had to buy back the 6700s for a loss, and I started selling 6800. I started selling the 6700 calls, and I started selling as low as 6650 calls. Eventually we sold the bottom, but that's actually something a little bit more risky. So these are the strikes that we decided to go over. Now this is how you kind of determine how to participate in the market at this given time, right? So we know that the market started to flush. It was not looking good. Momentum was clearly to the downside. Now, which strikes would you want to be selling at this time? What is the likelihood of the market reversing this move? That's something I wanted to put forth here. So you see that 6,700. We know that 1 billion is a strong level, right? 1 billion is a level that usually doesn't get taken out. At this point in time, we had 6,700 sitting at 3 billion. It actually peaked out at 3.61 billion. So for anyone who is looking to buy the dip and potentially get some sort of reversal, what is the likelihood of the market reversing negative 3.61 billion of deltas with just a few hours left in the market? It's very unlikely, right? So if we know that it's very unlikely, what can we do as traders who are trading options, right? We can choose to instead sell strikes around 6,700, right? Sell calls so that we can collect the credit for them as they're elevated, knowing that there's a high likelihood that price is not going to ever come back up to these strikes because of how strong those deltas are negatively, right? And we can use Vanna to sell the strikes with the most Vanna exposures, right? That would be 6,700 again, and then in the end it became 6,650 that we knew that price was not going to revisit, right? So I think these were the ones that I sold to hedge afterwards, 6,800, 6,700, and then eventually my last one was 6,650, right? So why did I choose those strikes? All because of the profile here. 6,650, 6,700. We knew 6,700 was not going to happen. The 6,800s, that happened way early on, and then happened that happened around like 8:30, just as London closed. But does this kind of make sense to you guys here in the chat? Give me a thumbs up if it does. Let me fix this camera angle a little bit. Perfect. I see some thumbs up. Perfect. Boo says thumbs down. Oh, that's not good, my friend. We can always sit down and chat another time if you're not understanding. But that is it. right? So that is actually that's like the entirety of it. So I'm going to go ahead and share this after I edit some of this stuff. Let me see where it goes. Where was the one thing I wanted to edit? It's somewhere here. But actually, before I do that, I'm going to close it off for YouTube. So for those guys watching on YouTube, thanks for watching. Give me that thumbs up, subscribe, comment, like, I don't know, whatever you want to do. But if you want to watch us trade this stuff live, every New York session, it's me and the gang here in Quant Data, and you're welcome to join in and watch and hang out and learn a little bit more about a data-driven approach to trading the market. So goodbye, YouTube, and see y'all another time.